you to today's webinar titled The New Tax Reform Bill's Impact on Tax-Exempt Employers and Their Employees. Today's presenters are Sam Hoffman and Belinda Morgan. Sam is a partner in Foley's San Diego office. Sam represents healthcare providers and governmental entities throughout California and United States in employee benefits matters, with emphasis on such matters as pension plans, executive deferred compensation programs, health plans, bonus programs, compensation matters, and insurance issues. Sam serves as benefits counsel to several nationwide healthcare organizations. His long-standing relationships with these clients have enabled him to become familiar with all aspects of benefit law in the healthcare arena. Belinda Morgan is a partner in Foley's Chicago office. She focuses her practice on employee benefits, executive compensation, and ERISA issues. Belinda has experience advising both public and private and for-profit and nonprofit employers in the design and administration of traditional defined benefit pension and profit-sharing plans, tax-deferred annuity plans, and non-qualified deferred compensation plans. She also assists employers with matters related to the health and welfare benefits plans, such as issues related to the Affordable Care Act, COBRA continuation coverage, and the provision of fringe benefits. Before I turn today's presentation over to our speakers, I'd like to go over a few housekeeping items. Today's program will last approximately 1 hour. We encourage you to submit written questions during the program. Please type your question into the Q&A widget open on the left-hand side of your screen. We will respond to written questions at the end of the program, time permitting. The webcast console you are looking at can be completely customized. You can resize or move any of the windows that you have open, including maximizing the PowerPoint presentation on your screen. If you experience technical difficulties during the presentation, please visit the webcast help guide by clicking on the Help widget below the presentation window, which is designated with the question mark icon. The PowerPoint presentation is available for downloading on the Resource List widget. It will also be available on Foley.com within the next few days. With that, I would now like to turn the presentation over to our speakers.
Thanks, Kayla. On December 22nd, 2017, the President signed the Tax Cuts and Jobs Act, or H.R. 1, into law, and not quite 2 months after the legislation was first introduced into the House of Representatives on November 2nd. As those of you who followed the whirlwind of activity that accompanied the legislation know, the act was on a fast track for passage. It was approved by the House of Representatives just 2 weeks after its introduction. The House's version of the legislation not only reduced the corporate tax rate and the number of individual income tax brackets, but also changed or eliminated many popular individual tax deductions, such as the home mortgage interest deduction, the state and local tax deduction, the teacher's expense deduction, and the student loan interest deduction. After much debate about the contents of the House's version of the bill in the public, the Senate introduced its own version of the legislation on December 1st. Now, unlike the House's version of the bill, the Senate version left many of the deductions slated for removal under the House bill, such as the student loan interest and teacher's expense deductions, in place. And while it retained the current 7 individual tax brackets, the Senate version of the act did adjust their limits. The Senate passed that bill with only minimal debate on December 2nd. The bill then headed to reconciliation, where Republican representatives from both of the houses negotiated the terms of the final bill. Once the terms of the acts were finalized by the conference committee, it was then passed by both houses of Congress on December 20th, basically on a partisan basis, with only Republicans voting for the legislation. The act represents the most significant revision of the Internal Revenue Code since 1986, when a bipartisan Congress attempted to overhaul the code and simplify it, broaden the tax base, and eliminate various tax shelters that were part of the code at that time. The act, though, makes many sweeping changes to the code. For instance, it slashes the top corporate tax rate from 35% to 21%. It also lowers the top individual tax rate from 39.6% to 37%. In addition, the Act also adjusts some of the income limits within the 7 current individual tax brackets. And for 2018, the standard deduction that all individuals are permitted to take will be increased from $6,500 to $12,000 for individual filers and from $13,000 to $24,000 for married couples. The Act does, however, eliminate the personal exemption that filers could previously take for themselves, their spouse, and their dependents that was allowed under the code. The Act also makes numerous changes to the deductions available to filers, such as capping the deduction for state and local taxes, both property and income taxes, at $10,000. It also limits the deduction for mortgage interest for homes that are acquired after December 15, 2017. Under the Act, now only interest on amounts up to $750,000 will be eligible to be deducted. And finally, it also effectively repeals the Affordable Care Act's individual mandate, effective starting in 2019. The Act will also double the estate tax threshold, increasing that threshold from $5.6 million for 2018 to $11 million for individuals, or from $11.2 million to $22 million for married couples. And then it also changes the way in which publicly traded companies approach executive compensation, significantly affecting the deduction that those companies can take for such compensation. Many of the Act's changes on individual taxpayers, such as the increased standard deduction and limits on the various deductions that can be taken, will likely reduce the number of taxpayers who elect to itemize their expenses when they fill out their taxes each year. Many tax-exempt organizations have expressed concern that if taxpayers no longer need to itemize their expenses due to the increased standard deduction or lack of other deductions, that will in turn reduce their incentive to make charitable gifts. And in fact, one study from the Lilly School of Philanthropy at IUPUI in Indianapolis, Indiana, estimates that the changes could cost charities $13 billion or more per year in lost charitable contributions. Likewise, the increase in the estate tax threshold will further reduce the number of taxpayers who have estates that are actually subject to the estate tax. Right now, that's about 1% or less of all estates that are subject to the estate tax. So increasing the threshold is estimated to cost tax-exempt organizations about $4 billion a year. In addition to the collateral effects that tax-exempt and charitable organizations may face as a result of the Act's changes to the standard deduction and the various other deductions that are available, as well as the estate tax threshold, the Act also includes a number of provisions that directly impact tax-exempt organizations. For example, beginning in 2018, the Act imposes an excise tax of 1.4% on the investment income of private colleges and universities with 500 or more full-time tuition-paying students, so long as at least 50% of those students are located in the United States, and the college has an endowment with assets of at least $500,000 per student. Until this change was put into place by the Act, earnings on institutions' endowment funds were not generally subject to taxation, so this is a very big change for such institutions. In addition, the Act modifies how tax-exempt institutions will calculate unrelated business income for purposes of calculating their unrelated business income tax, potentially increasing their liability as a result of those changes. The Act also repeals the exclusion from gross income for interest that accrues on advanced refunding bonds, essentially eliminating the market for such bonds and removing a popular means for nonprofits to reduce the cost of their borrowing. And then finally, the Act imposes an excise tax on excess compensation paid to certain highly paid employees of tax-exempt organizations. This is a significant change for tax-exempt employers. They've previously not been subjected to any sorts of limits or requirements on compensation they pay to their executives, other than the requirement that the compensation be reasonable. The excise tax may make it more difficult for tax-exempt organizations to find and retain top talent as a result. And so I'm now going to turn it over to Sam to discuss how this excise tax works and how it may impact nonprofit employers. Sam?
Thanks, Belinda. So this is the crowning achievement, if you will, of the Tax Reform Act with respect to tax-exempt entities, in that they've gone after the key executives and their compensation. I think an overarching trend in the provisions that were considered for this law and that were implemented is that there are a number of key senators and congresspersons who are unconvinced of the value of tax exemption, in that they're questioning whether the entities, especially the larger tax-exempt entities, are really deserving of tax-exempt status. And that's clear in a lot of their comments. But what they ultimately ended up doing was zeroing in on the thing that seems to bother the legislators more than anything else, and members of the general public, which is the pay given to key tax-exempt executives. And this is not uncommon. Any of you, the Bolsheviks found out when they had their revolution 100 years ago that people don't mind if they're poorly off, they just mind if someone's doing better than them. And so there's a lot of that. So that's what's going on here. So this tax, which is for the first time applied, the concept of imposing a penalty on paying an executive more than $1 million, is now imposed on tax-exempt organizations. And this would be any type of tax-exempt organization out there. And it's going to be the current corporate rate, which is 21%, as you probably read in the papers in terms of what the corporate tax rate was dropped to. And this will apply to any compensation in excess of $1 million, and that's paid by the organization to the covered employee, and that's going to be the key executives. We'll go into who those key executives are in a second. In addition to that tax, and that will be paid by the employer, not by the employee, not by the executive, there's going to be an executive or excess parachute payment tax, and this is basically severance pay, payments that are contingent on someone leaving. So in most instances, this is going to be severance pay that exceeds 3 times the annual salary. They do a 5-year look back, called a base amount or base salary. But that's an additional 21% excise tax. If you do give somebody a severance package that's worth more than 3 years of pay, then you're going to have to pay, as the tax-exempt entity, this excise tax, 21% on the amount over the 1 year, one base amount. So this is a big change, and it is, as I say, something that's going to be paid by the tax-exempt entity. So let's get into the nuts and bolts of this a little bit more. So the first thing we have to consider is what is compensation, and so this is generally going to be wages or taxable wages, things that show up in box 1 on the W-2. And so that would be cash and salary, bonuses, that sort of thing. But it also would be any non-cash benefits that are taxable to the key executive. And so, as I said, the best rule of thumb is just to look at the box 1 in the W-2. The other thing that can come into this, and this would show up in box 1, is deferred compensation. In a tax-exempt setting, a non-qualified deferred compensation plan, that is to say something other than a 403B program or a 457B program or a qualified 401A retirement program, if you have an additional executive SERP or something of that sort for key executives, they generally will realize income on the amounts in that plan as soon as it vests. The technical term is as soon as it's no longer subject to substantial risk of forfeiture. So if you have a deferred comp plan or a bonus plan that takes a few years to vest, a long-term incentive where certain goals are achieved, the money vests. So even if it's not paid out, it's included technically in income in the year it vests. So that would be added to the salary, wages, cash, and non-cash other benefits that the executive gets for purposes of calculating this $1 million threshold. So I think as you start thinking about what to do about this going forward, you start thinking about the package of pay and benefit arrangements that the executive has, and figure out what fits in here, and start thinking about when those bonuses and deferred comp are going to vest, so that you can calculate when that tax is going to hit. The next item we want to talk about is what isn't included in compensation. And so this is going to exclude anything that are a qualified retirement program. So we've got pre-tax or Roth contributions to qualified plans are not, and other amounts that are not included in gross income. We've got any portion of compensation, and this is a key to the medical industry, where we've got if you've got a physician or a nurse who is one of the top 5 paid employees and is being paid for the performance of medical services, then that amount doesn't count towards this tax. Now, a lot of times you'll have physicians that will work and have administrative responsibilities, perhaps coupled with some professional responsibilities, and so you have to divide the compensation and allocate, have some way of demonstrating how you allocated it between the professional services and the administrative services, which do count towards this excise tax. So those are, in terms of, again, thinking about implementing this starting this year, is to start reflecting on who your top 5 are, and then looking at whether any of these people are going to be fitting within this medical services, medical professional exemption. The next item to consider is when is compensation paid? And so we as we were discussing a little earlier, when you've got a non-qualified deferred compensation plan, once it vests, it's included in income, even if it's not paid until later. So, and by the same token, once you've included it in tax, it doesn't count when it comes out. There's basis in that amount. But that's in terms of trying to figure out when this tax hits. You need to pay attention to those vesting cycles. The other pieces are current compensation and pay for that year. So it's a planning exercise that you haven't done before. You're going to need to go through compensation for these key executives and determine who's going to be subject to it, and whether there are any strategies that you could take to spread the money, or the vesting on the non-qualified deferred comp over a few years to setting up these programs to avoid the tax. Of course, any arrangements you've already got in place, you have a contractual obligation, as you're right now just going to be figuring out what the tax is going to be and when it's going to hit. So the next question, we've talked about covered compensation, is who is the covered employee of the tax-exempt organization. So let's, before we delve into the people, let's talk about the organization. So the statute, as written, talks about an applicable tax-exempt entity. So it's any kind of tax-exempt entity, and the tax and the covered employee is all defined by reference to this organization, this applicable tax-exempt organization. We don't have any regulations or guidance from the IRS. That'll be forthcoming in due time, I'm sure, but for right now we have to use a reasonable interpretation of the statute. So if you have a smaller tax-exempt organization that simply has one entity that is the legal organization and the business unit, so it's pretty easy to figure out who the employer is for purposes of running these analyses. But if you've got a larger corporation, let's say you have a healthcare system where you've got multiple hospitals in a system, if each hospital is set up as a separate corporation, a separate tax-exempt corporation, then it would appear that this rule would apply separately to each tax-exempt organization. And it talks about if there's an employee who is working for multiple organizations, that you would allocate the salary over the multiple organizations. So that you might have to look at the top 5 people in each tax-exempt organization. Now, a lot of health systems will put the key executives, the C-suite people, if you will, at the hospitals on a corporate payroll, and not have them on the local hospital corporation payroll. And so that is an issue that you'll need to wrestle with as to where you place those key executives. It seems like a reasonable argument could be made that those executives are to be looked at with respect to the corporate entity, and you would just look at the employees that are on the corporation payroll, the local corporation payroll, for purposes of looking at whether they have any additional 5 employees who are covered employees for purposes of this tax. But that's something you should keep your eyes peeled for from the IRS as to what they say. If you've got a CEO of a hospital unit who spends all of his or her time at that local hospital but is technically on the corporate payroll, where you would assign them. And so there may be guidance on that. Once you've selected your organization, I should also add that a number of tax-exempt systems use DBAs for the local business unit. In other words, they're all part of the same corporation. They may do business under a different name, but that's a fictitious business name. It may even be the name they have the license under, but they're technically not a separate legal unit. And so there, I think you would have a reasonable interpretation that you would look at it on the large corporation system basis. But again, you should keep your eyes peeled for guidance from the IRS. But once you've picked the organization that you're comfortable with as the universe for this analysis, then you look and say which the employees, the 5 highest paid employees for the taxable year. And so again, we've discussed how you calculate pay. So you have that. You should now be able to tell who the 5 highest paid people are that year. So that's an easy determination. The other piece, and this is a tail, if you will, that comes with this definition, is that if the employee was a top 5 covered employee in prior years, they basically bear the mark for the rest of their time with you. And so they're always going to be a key employee. Now, as a practical matter, the C-suite people usually don't go to a C-suite position and then take a demotion and continue working for the organization. But it does happen, and if it does, such a person would also be treated as a key employee or a covered employee. So this slide just goes into what we've discussed, that you do have to keep track of it. So you'll have to set up a system as to once an employee has been deemed to be a covered employee, you keep them on a list. And this is basically just a new system that your finance folks are going to have to put in place to keep track of who the covered employees are in a year, and including these legacy covered employees, and to run these calculations as to whether the tax is due and how much it is. The liability we talked about is on an entity by entity basis. So that is an exercise that all of you will want to engage in now, is to analyze what are your entities. If you're a multiple business unit system, what are your business entities? If you're just one business unit, it won't take very long for you to make that determination. And the next bullet on this slide just addresses the point that when the employee comes from one or more or entities within the control group, you're going to allocate it among the employers. And so you basically can't spread people out and divide the tax up that way. As I said, there is that issue of officers who are on the corporate payroll and working for a business unit, how that will play out. The next tax that is developed by this statute is the excess parachute payments, and we talked about this at the beginning. This is we'll call it the severance pay tax, and so this goes to any excess parachute payment, which is severance pay more than 3 times annual salary, basically, paid to a covered employee. So again, you've already gone to your exercise to figure out who the top 5 plus legacy are at your particular entity, and you'll then have if you give this person a severance pay, you're going to have to pay an excise tax, 21% now, tax on the present value, if it's a stream of payments, that is more than 1 times the base amount. Now, this, in terms of severance packages, the payments that are contingent on the separation from service and would only be obtained in that situation. The key fix is to make sure that the severance pay is, if you want to avoid the tax, is less than 3 times base salary. And I will say, in my experience, I don't see that many severance packages that are that long. More in the nature of 1 to 2 years is more common. But if you do have packages, of course, if you've already made an agreement to provide a severance package that's bigger, you have that contractual obligation. But this is something to inform the development of future severance packages. The parachute payments don't include payments from qualified retirement plans or 403B or the 457B arrangements. So those don't count. Even though the 457B money that's paid out of a tax-exempt program, tax-exempt employers program, will be recorded on W-2 income, there you will note, it will be noted on the W-2 that it came from a 457B plan, and that doesn't count towards this excise tax. If you've got a top 5 person who's not highly compensated, and under the usual pension rules, which is a much lower amount, then they're not subject to the parachute payment. And of course, if they're down around $120,000 level in compensation, you're not going to get any of the $1 million plus excise tax either. So in any event, the parachute payments, even if it's more than 3 times, is not going to apply to a non-highly compensated. And then there's an exemption, which is consistent with what was done with the salary excise tax, that payments made to licensed medical professionals for their professional services also are not, if the severance is paid to them, it's not applicable. Presumably, if you have a mixed duty professional employee who also has some non-medical professional duties, you would allocate this salary. And as I say, there's no regulation, so the reasonable interpretations could be made as to whether the medical professional salary counts towards the highly compensated definition, whether, if it does, the medical or professional salary should be ratably allocated, and that if there is an excise tax on the severance, because it's more than 3 times the severance package becomes an excess parachute payment, whether it applies to only that portion attributable to the non-medical professional work. So that's something that you'll need to think through with your advisors as to what the appropriate interpretation is if you have a situation like that. Now, in terms of calculating the parachute payment, to get into the nuts and bolts, a covered employee's base amount, and that is the unit that we've looked to determine whether the package is more than 3 times the base amount, is basically the same method that you use for for-profit entities. You don't get a deduction for compensation paid over $1 million, and the covered employees is equal to the average taxable compensation. So again, it's box 1, cash and taxable non-cash compensation for the 5-year period ending before the separation from employment. So you need to go back and do an average, and that's how you pick that up. And so there is somewhat of a disconnect, because most severance packages that I've looked at over the years are based on current salary, final salary, not on an average over the last 5 years. So it may be, if someone has had an executive has had some healthy salary increases over the last 5 years, which is not uncommon, depending on how business cycles run, and a career trajectory, that you might pay someone 2 times annual salary as a severance package, or maybe even 1.5 years, and it could work out to be more than 3 times the 5-year average. So again, this is something that the finance folks, if you've got severance packages, need to start now setting up the paperwork to keep track of, to know what's the base amount in any given year, and is this severance package, if it happens to be triggered that year, bigger than that. And even if you don't keep track of it on an ongoing basis, it's something you'll have to do before you pay out severance pay, so you'll understand whether you have tax for that year. If you do get over 3 times, then the excise tax, which is on the amount by which the severance is more than 1 time that 5-year average base unit, then the tax-exempt organization is going to be liable for the tax. Again, it's not the executive that has to pay it. And so it's different from some of the other penalties for unreasonable compensation, some of which are assessed, penalties or which are assessed against the executive, his or herself. This one goes to the tax-exempt organization. The purpose of this, going back to the comments we made at the beginning, is to level, or try to start leveling the playing field between tax-exempt business organizations and for-profit business organizations. And the thinking on this, from the comments from legislators that we read during the development of this law, indicate that this was intended to mirror the rule for-profit entities, public corporations, that prohibits them from taking a deduction for compensation above $1 million. This is try to make it a similar affair, and that's why the excise tax is equal to the tax that the for-profit entity would have to pay on amounts paid over $1 million because they wouldn't get a deduction. So that's the and it again is indicative of this notion that especially the larger tax-exempt organizations, the notion that is held by a number of key legislators really isn't good public policy. And so this is a sign of their thinking on this. Now, the excise tax we got here, it could make it more expensive to recruit and retain. It will make it more expensive because if you're going to pay compensation over $1 million, which is not uncommon for a very large organization, then the expense of that executive goes up because you now got this excise tax that you're going to have to pay. Whether that changes pay practices or not remains to be seen. If it's a very large organization with multiple billions of dollars in income, paying an excise tax on $1 or $2 million of excess executive compensation probably is not going to be outcome determinative in terms of what compensation is paid to an executive. But again, that will remains to be seen. One issue that I think tax-exempt entities should focus on or are focusing on is what's the impact of this new excise tax on the reasonableness of executive compensation? And I'll say at the outset that there's generally a requirement that compensation be reasonable. And I'll talk about that in the next slide a little bit. But this, at a high level, we don't see anything to think that this new tax by itself would render otherwise reasonable compensation unreasonable. However, I think that as with some of the other key points that are undeveloped in this new rule, that you should stay alert to changes in the IRS guidance with regard to this issue. The rules for tax exempt, and I'm going to focus here on the 501c3 entities, is that you can only pay reasonable compensation to executives. There's a rule in the statute that says if we're going to give tax exempt status to an entity, that no part of the net earnings can inure to the benefit of a private individual. Basically, you can't be paying profits out to an individual and still call yourself tax exempt. So early on, the IRS ruled that it was okay to pay wages to employees by a tax-exempt organization. That didn't violate that rule, as long as the compensation was reasonable. Generally, with rank-and-file people, that isn't an issue. But with the key executives, it becomes more of an issue. And the IRS has been known over the years to scrutinize that issue with tax exempts. And so they've issued some regulations and guidance over the years on this topic. And reasonable compensation is generally defined as the amount that would ordinarily be paid for like services by like enterprises, whether taxable or tax exempt, in like circumstances. So basically, you do a salary comparison and see what's our competitor paying, what's other people across the country paying for this kind of work. If you're wrong about your determination and you as a tax-exempt 501c3 entity pay your executive too much, so then the executive can be hit with a 25% excise tax on the unreasonable compensation. And as I mentioned earlier, this is different than the new excise tax on compensation over $1 million, even if it is reasonable, which is just paid by the tax-exempt entity. And there can also be, if it's unreasonable compensation, a 10% excise tax on board members who approve the compensation. This isn't new law. This is current law, but we're talking about how the new law might apply to this. And in very bad situations, the employer's tax exempt status could be lost. But again, if the tax exempt entity is performing an important mission, such as the hospital system, generally the IRS doesn't want to pull the tax exempt status, so they would go with these excise taxes instead. Now, among the IRS rules that they've developed over the years is that tax exempt organization's board can create a rebuttable presumption of reasonableness on compensation if it does a couple things. First, it obtains appropriate data on comparability. And usually this comes in the form of a report from a reputable compensation consultant. And so basically before you set the salary for the key executive, you get a report that says this is what's reasonable. And a lot of boards will say, okay, we're going to aim for the 50th percentile or the 75th percentile because we want to get the little bit better quality executive. And so then you would get to this compensation consultant who would give you a report on kind of what the industry is doing. So they act as your eyes and ears, and you have a record that you got that. The compensation is then approved in advance by the directors after reviewing and considering that report or any other data. And you could do it yourself, but most common it's to use a compensation consultant. And the board members who vote on it don't have a conflict of interest. In other words, they're not going to get anything as a result of this. And the board documents the process in writing. So if you do those things, the IRS had said that we'll presume, unless we have some strong contrary evidence, that the compensation is reasonable. So the interesting thing about this new tax law is that early on in the process, it was proposed that this be removed, this rebuttable presumption of reasonableness, and it was going to be statutorily required that you go through this process of getting data, comparability data, and documenting it, and having a vote in advance by disinterested directors, but that wasn't going to get you anything as a way of a rebuttable presumption. That was just table stakes for being able to do it without having a presumptive violation. But interestingly, that was cut out of the act, and the only thing that was left was the excise taxes and the parachute and the compensation over $1 million that we've been discussing. And so it gets us to the conclusion that as long as the executive's compensation, and this is at this point, we'll have to wait for guidance to come out from the IRS if they do issue guidance or see if there are decisions on this topic. But at this point, so long as an executive's compensation continues to meet that rebuttable presumption of reasonableness, so then the imposition of the new excise tax alone shouldn't affect the reasonableness of the executive's compensation. Or at least we think a good argument could be made to that effect. Obviously, each of you will make your own decision in consultation with your advisors on that question. But we think that's a reasonable argument can be made in that regard. Now, it's possible down the road that if tax-exempt entities begin reducing executive compensation to avoid the tax, that might eventually affect what's considered reasonable in terms of comparability. Again, but as I said earlier, if you've got a very large organization with multiple billions of dollars in business, paying an excise tax on $1 or $2 million of excess compensation, or even a few more million than that, is probably not going to be outcome determinative for such a large organization if the board thinks that it's worth it to get the best quality executive for which you have to pay. And it's possible that the IRS may issue guidance in the future that will impact this analysis. But right now, as I said earlier, you have an obligation to use a reasonable interpretation of the statute. So as you stand back with this new executive compensation issue, the things that you should do, and we've alluded to this, is you should determine who your covered employees are, and whether you've got an excise tax burden or not, and budget for it. Whether the existing severance package is going to trigger the parachute tax, and what the vesting schedule is on your non-qualified deferred comp, when you can expect to have a hit, if ever, from this excise tax. So those are the things. If you have a contractual obligation, you're going to have to stick with it. And the taxes are what they are. If you're making new contracts and new deferred comp arrangements, so then you can, to the extent possible, and it still meets your business needs, try to structure them to avoid the tax, or at least be mindful of the tax as you design them. All right, someone's going to give you the CLE code.
Yep, thanks, Sam. At this time, I'm going to read aloud the CLE code for this program. If you are in need of CLE credit today, please enter this 5-digit code into the poll question on the screen after it is announced and press the Submit button. The code is ROOHB. Again, ROOHB. One more time. R as in red, O as in octopus, O as in octopus, H as in Henry, and V as in Victor. Again, if you are seeking CLE credit for this session, please complete the polling question by entering the code that was just announced. The polling question will remain open briefly. For those of you seeking Kansas, New York, and New Jersey CLE credit, in addition to the polling question, you will need to complete the attorney affirmation form and return it immediately after the program. A copy of the form can be found in the Resource List widget. As a reminder, certificates of attendance will be distributed to participants approximately 8 weeks after the web conference via email. At this time,
okay.
I'm sorry.
Kayla, that's ROOHB?
That's correct. I'll give folks just another minute or two to fill that in. All right, and I'll turn it back over to our speakers. Thank you.
Thanks, Kayla. In addition to the specific changes on executive compensation that Sam discussed, there are a number of employee benefits-related changes in the Act that will affect both tax-exempt organizations and for-profit entities equally. The thing is, by removing or modifying some of the perks that tax-exempt employers can offer in lieu of the increased salary or wages that for-profits might be able to offer, these changes may have more of an effect on the ability of tax-exempt employers to recruit versus for-profit employers. So in the run-up to the passage of the Act, there were a lot of rumors about what it might or might not include. Some of those rumors stemmed from various proposals that had been in the Republicans' 2014 tax reform proposal. For instance, there were murmurs that Rothification of employee 401k and 403b plan contributions might be included, which would basically eliminate or limit the amount of pre-tax money that could be contributed to 401k or 403b accounts. And the rumor was that that might be possibly included in the Act. In the end, neither the House or the Senate versions of the bill included those provisions, but given that there were so many proposals that were first in the bill, then out of the bill, we thought it might be helpful to sort of clear the air about the benefits-related proposals that weren't included in the final version of the Act, as well as some of the other ones that actually were. So one of the proposals that was included in the House version of the legislation that caused quite a bit of concern for educational institutions, but that ultimately didn't make it into the final Act, was the proposal to treat graduate student tuition waivers as taxable income. Under current law, colleges and universities often provide tuition waivers to graduate students who are working as teaching assistants or researchers and so forth while they're pursuing their educations. And under the House version of the Act, students would have been required to include the value of those waivers in their taxable income and then therefore potentially pay tax on income that they never actually received. The proposal, as you can imagine, caused anxiety both with students and with college administrators, with the students being concerned that the elimination of the waivers taxable, the favorable tax treatment, would make post-secondary education more accessible and or more expensive and inaccessible to many, while the administrators tended to be concerned that it could also cause the loss of that program might impact their teaching and research programs. And in the end, pressure against the proposal worked, and it wasn't included in the Senate's version of the act and then did not make it into the final legislation. Similarly, there were several proposals to change retirement plan benefits that were included in early versions of the legislation, but that weren't adopted into the final version of the act. For instance, there were early proposals to eliminate the special catch-up contribution that's available to Code Section 403B and 457 plan participants, and to prohibit highly compensated employees, those making over $500,000 and who are over age 50, from making catch-up contributions. Those provisions were not adopted, and had they been, they would have limited the amount of pre-tax income that employees could have put into their 401k, 403B, or 457B plans. In addition, there were several proposals that were related to the aggregation of plan deferrals that were initially in the early versions of the Act. Under current law, Code Section 402G limits the amount of elective deferrals that employees can contribute to a Code Section 403B or 401k plan. And in determining that limit, whether that limit is met, and it's currently $18,500, an employee's contributions to any 403B plan or 401k plan have to be aggregated. In contrast, contributions to a Code Section 457B plan don't need to be aggregated for purposes of the 402G limit. Participants can contribute up to the full 457B limit, and that's also $18,500 right now, even if they're also contributing to a 403B plan during the year. So if an individual participated in a 403B plan and a 457B plan, in theory, they could contribute up to $37,000 for 2018, plus any catch-up contributions that they might be eligible for. The proposal that was initially under the Act would have changed that. It would have required 457B plan contributions to be included when determining whether the 402G limit, that $18,500 limit, was met, and that would essentially have cut an individual's elective contribution opportunity in half. Similar proposals were made for the Code's 415 purposes, but in the end, neither of those provisions was actually adopted into the Act, which is helpful for the employees. Likewise, there were proposals early on to eliminate the ability of tax-exempt employers to make contributions on behalf of terminated 403B plan participants, and that was also not adopted. Various proposals were included that would have made it easier for employees to receive hardship distributions from their plans, basically to take amounts from their plan accounts to use for disaster relief, et cetera. The proposals would have helped the employees because they could have obtained early distributions of those contributions, but it would have also helped raise taxes as well, since in many cases the distributions would have likely been subject to the 10% excise tax on distributions to participants who are under age 59 and a half. So in terms of what did change from an employer perspective with respect to retirement plans, the answer is really not very much. The Act does provide some additional relief to employees who take hardship distributions to deal with expenses arising from qualified disasters that happened in 2016. And it also provides relief to employees who may have had their plan accounts reduced or offset due to unpaid plan loans that they still had upon termination of employment or retirement. With those employees, they now have a longer time to repay the amount of that offset and avoid the adverse consequences. They would repay the offset by making it to a contribution to an IRA. Under prior law, they had 60 days from the date of the termination to make the contribution, and now under the new Act, they'll have till the end of the till the due date of their tax returns, including extensions for the year in which they had the offset occur to make the repayment. To the extent that employers want to provide either of these benefits, they'll need to make amendments to their plan, but otherwise these are tax benefits really to the employee, and there's no real requirement that the employer take any action. In the health and welfare plan context, the House had proposed to eliminate dependent care flexible spending accounts and adoption assistant programs. There was a fair amount of uproar about the adoption assistant programs not being included, and that neither of those two provisions were adopted into the final act. The main change that occurred with respect to health care plans was that the Act essentially repeals the ACA's individual mandate. And it does that by eliminating the penalty that would apply to individuals who fail to obtain suitable health care coverage. This will start in 2019. And this just means that if an individual doesn't go out and purchase the required type of coverage that they need, they won't be subject to any kind of penalty. There's no change, though, on employers with respect to the employer mandate. That still applies and still requires large employers or employers with more than 50 employees to offer affordable coverage that provides minimum value to at least 95% of their full-time employees and to the dependents of those employees. That requirement is still in effect. Finally, there were early proposals to eliminate a number of different fringe benefits, including educational assistance programs, housing provided for the convenience of the employer, and the deduction for teachers who use their own money to purchase school supplies. None of those requirements were adopted into the Act, especially with the teachers deduction. There was a lot of outcry about that, and even with some of the other educational programs as well. What did change was the employer deduction for qualified transportation benefits, such as transit vouchers, payments for parking fees, and so on. That was eliminated by the Act. And as a result, if an employer provides employees with transportation benefits, for instance, if an employer gives its employees $100 per month to buy bus or train tickets, the employer can no longer deduct that payment as a business expense. The only way it could do so is if it would treat those payments as taxable W-2 wages to the employee. That change is not likely to have a lot of an impact on tax-exempt employers, other than potentially being included in unrelated business taxable income in some circumstances. That's one of those UBIT changes under the Act that comes into play. In addition, the employees who are using their own pre-tax contributions to pay for transportation expenses won't be affected. They'll still be able to take those amounts on a pre-tax basis. The one thing they won't be able to do, however, is to receive qualified bicycle commuting benefits of $20 per month as a tax-free benefit. That benefit was eliminated in the Act. So apparently the writers did not care for the bicycle benefit. The Act also made changes to employer deductions for business-related meals, but again, that's really unlikely to have much impact on tax-exempt employers. One change that may have some impact on tax-exempt employers is the elimination of the income exclusion for qualified moving expenses. Under the Act, employees can no longer exclude those expenses from income. It used to be that they could, or they could exclude amounts that an employer paid on their behalf for moving expenses. There are some exceptions still for military personnel, but for the most part, the exclusion has been eliminated. And that may make it harder for tax-exempt organizations to offer moving expenses as a benefit when they're recruiting new employees. As any amounts that they pay or they reimburse the employee for moving costs will need to be included in the employee's W-2 form. That said, it's still possible that, as Sam was mentioning, the exempt organizations are going to want to get the talent that they want to get. So they may offer the benefit in any case and just gross up the employee so that the tax impact of the loss of the moving expense exclusion isn't really a factor in the employee's decision whether or not to work for the organization. And with that, I'm going to turn it back over to Sam for some final thoughts regarding the Act and its effect on tax-exempt employers. Sam?
Thanks, Belinda. Yes, so I think the bottom line of all this is, as we've mentioned a couple of times, is that there are key members in Congress who are questioning whether tax-exempt status, at least for large entities, is good public policy. And as Belinda mentioned, there were a number of proposals that would have had a big impact on how you manage employee benefits and other areas of tax-exempt operations that didn't make it to the final law. But once ideas are circulating in Washington, they tend to pop up again. So we probably haven't seen the end of a lot of this, and we certainly got hit with these new excise taxes. So the main takeaway, I think, for tax-exempt organizations is to do it on your own and work through your trade associations to make it clear to the public, to local officials, and to congressional officials in your area the good works that you're doing, the reasons that you're better for the community than for-profit entities. The things that you bring to the table, not that for-profit entities are bad, we certainly want them, but that you're bringing to the table a lot of community service that couldn't be brought in the for-profit context, and that's a reason for continuing your status. So I think that's the main takeaway. We've talked about getting yourself structured for these new laws. But the main policy change is that you really need to highlight the good works you do. And I know that there are a lot of, working with the tax-exempt world for many years, that there are a lot of good things you do and the ways you approach issues that aren't used in the for-profit sector. And so I think those are the things you need to really work to highlight, even though, of course, you have to meet budget and not go into bankruptcy, but that you really highlight the good works you do so that you win the public policy debate about whether tax exemption is a good idea. With that, I'm going to turn it over to Kayla.
Thanks, Sam. Thanks, Belinda, as well. This wraps up our webinar for today. We ran out of time to answer questions, but we invite you to contact Sam or Belinda if you have additional questions that you didn't ask on the widget. We will follow up with you to answer those questions. Also, at the conclusion of this program, a questionnaire will appear on your screen. Please take a minute or two to give us your feedback about the presentation. It's really important for us to know your thoughts and helps us shape our programs for future. And if you have any questions about CLE or a copy of the slides, please contact me at khooven@foley.com. Thank you for your participation and have a great rest of your day.